Have you ever wondered how the world's most successful investors like Warren Buffett manage to find the best opportunities in the stock market? The answer lies in understanding a powerful concept that Buffett swears by: intrinsic value. It's not about following market trends or listening to the latest stock tips. Instead, it's about learning how to calculate the real value of a company based on its future potential. But here's the catch: most people don't realize that the true value of a company isn't always reflected in its current stock price. Imagine buying something at a great discount, only to have everyone else catch on later and drive the price up. That's the kind of strategy Buffett has mastered. By understanding and calculating intrinsic value, you can avoid the mistakes of buying overhyped stocks, and instead focus on those with real, long-term potential. In this video, I'm going to walk you through how to calculate the intrinsic value of a company, just like Buffett does. You'll learn how to estimate future profits, use the right discount rate, and make smarter investment choices that set you up for long-term success. Ready to uncover the secrets of one of the greatest investors in history? Let's dive in. Warren Buffett is considered one of the greatest investors of all time, and the reason for his success lies not just in his ability to pick stocks, but in a fundamental concept: intrinsic value. For Buffett, intrinsic value is like the fair price of a company, based on what it's really worth, considering its future profit potential. This concept moves away from speculation and market fluctuations, forming the core of the fundamental analysis Buffett uses to make his investment decisions. The concept of intrinsic value goes beyond just a simple price calculation. It's based on the future cash flows of the company, how much money it's expected to generate over the years. This money is then discounted to calculate its present value, using a discount rate that can vary depending on market conditions or investor expectations. When the intrinsic value is greater than the market price, Buffett sees this as a buying opportunity, believing that the market will eventually recognize the company's true value. The key takeaway here is that intrinsic value is not just a magic formula, but a deep reflection of the company's ability to generate profits in the future. Buffett often says that a true investor cares more about the company's financial health than the fluctuations in stock prices in the short term. By calculating intrinsic value, he makes informed decisions based on solid data, avoiding the herd mentality of the market. That's what makes his investments so successful. Intrinsic value is essentially the true worth of a company, and understanding this concept is crucial to making smart investment choices. Imagine this: it's not about how much a company's stock is selling for today, but how much it can generate in the future. To Warren Buffett, intrinsic value is a measure of the company's future profits, and it's something you need to calculate if you want to be a successful investor. It's the key to finding out whether a stock is underpriced or overpriced, guiding investors toward smart, long-term investments. Buffett defines investing as paying money now to receive more money later, and the concept of intrinsic value fits perfectly with this definition. You're essentially betting on the company's ability to produce future cash flows, which are then discounted to their present value. Think of it like buying a home or a carrot's price today reflects the future value you expect to get from it. Similarly, the value intrinsic to a company depends on its future cash flows, minus any risks or uncertainties that might affect those profits. Understanding intrinsic value is like having a roadmap in the world of investing. You can make better decisions and avoid buying stocks that are overhyped or overpriced. Buffett's genius lies in his ability to identify companies with strong intrinsic value, even when the market may not fully recognize it. It's about finding gems in the rough, companies that are undervalued and have massive long-term potential. So, if you're serious about investing, learning how to calculate intrinsic value is a must. Calculating intrinsic value might sound complex, but with the right approach, it can become a powerful tool in your investment strategy. Let's break it down step by step so that it feels less like a math puzzle and more like a straightforward process. The first step in calculating intrinsic value is estimating the future profits a company will generate. This often involves looking at its historical performance, industry trends, and potential for growth. But remember, this is not about guessing, it's about making an informed projection based on data. Once you've estimated those future profits, the next step is to discount them to the present value. This is where the discount rate comes into play, which is typically based on the risk of the investment and the expected return. You can think of the discount rate as a way to adjust future profits for their value today, since money in the future is worth less than money now. The higher the risk, the higher the discount rate, and vice versa. It's a critical part of the process because it ensures you're considering both the time value of money and the uncertainty of future earnings. Finally, you compare this calculated intrinsic value with the company's current market price. If the intrinsic value is greater than the market price, that's often a sign the stock is undervalued, an opportunity to buy at a good price. But if the market price is higher than the intrinsic value, the stock might be overpriced, and it's best to avoid it. In the end, calculating intrinsic value gives you a clearer picture of a company's worth and helps you make investment decisions based on logic, not emotions. The discount rate is one of the most important factors when calculating the intrinsic value of a company. This rate determines how much future cash flows are worth today. In simple terms, it reflects the idea that money in the future is not as valuable as money in your pocket right now. If you expect to receive 100 in 5 years, that 100 won't have the same value as 100 today due to inflation, risk, and the opportunity cost of not being able to use that money in the meantime. Buffett often chooses a discount rate based on the risk-free rate, such as government bond yields, and adds a premium for risk. The more risk you associate with an investment, the higher the discount rate you should use. This is because a higher discount rate lowers the present value of future cash flows, making it less likely that the stock will appear undervalued. The discount rate acts as a filter, helping you assess whether the investment is worth the risk and whether the company will meet your expectations. When you apply the discount rate properly, it can help you avoid overpaying for a stock that may seem cheap at first glance. It gives you a more realistic picture of a company's true value by adjusting for both the time value of money and its inherent risks. Understanding how to choose the right discount rate is key to making sound investment decisions, just like Buffett does. By mastering this process, you'll be better equipped to spot undervalued stocks and build a more reliable portfolio. Cash flow is the lifeblood of a business, and when calculating intrinsic value, it's essential to focus on this rather than just reported profits. Profits on paper might not represent the company's actual ability to generate money, but cash flow always does. A company can report high profits but still be struggling with liquidity issues if its cash flow is weak. That's why understanding and calculating cash flow is so important. Gives you a true picture of how well a company is positioned to produce future earnings. Warren Buffett has repeatedly emphasized that cash flow is a more reliable indicator of a company's financial health than earnings alone. This is because cash flow shows the real movement of money in and out of the business, making it easier to predict future financial stability. For instance, if a company has strong cash flow from its operations, it can reinvest in growth, pay off debt, or return value to shareholders through dividends or stock buybacks. These factors are essential for determining the long-term viability of an investment. When calculating intrinsic value, you need to estimate the future cash flows the company will generate. This requires looking at past trends, industry forecasts, and the company's growth prospects. Once you've estimated these future cash flows, you can apply the discount rate to get their present value. By focusing on cash flow and using it as the basis for your intrinsic value calculation, you're aligning with Buffett's strategy of investing in businesses that have a consistent ability to generate profits in the future. Calculating intrinsic value goes far beyond simply picking stocks. It's a critical part of building a long-term investment strategy. By focusing on a company's true worth, you're adopting a mindset that looks beyond short-term market fluctuations. Warren Buffett famously advises investors to buy businesses they would be happy to own for a lifetime. This is the foundation of his strategy, purchasing companies at a fair price based on their intrinsic value, with the expectation that the market will eventually recognize their worth. Intrinsic value helps investors avoid the common pitfall of chasing quick gains or reacting to market noise. Instead, it encourages a focus on fundamental business health and future growth. By understanding a company's intrinsic value, you can invest with confidence, knowing that your decisions are rooted in solid analysis. Buffett's success is a testament to the power of this approach, as he's consistently made investments that prioritize the long-term prospects of businesses over short-term price swings. By using intrinsic value as the cornerstone of your investment strategy, you can weather market volatility and stick to your plan even when the market gets jittery. This focus on long-term strategy allows you to invest in companies with real potential, rather than following trends or trying to time the market. Whether you're a seasoned investor or just getting started, adopting this mindset will significantly improve your chances of building wealth over time. Finding undervalued stocks using intrinsic value starts with calculating the true worth of a company based on its future earnings potential. Once you've estimated the future cash flows and applied the discount rate, you can compare the intrinsic value with the company's current stock price. If the intrinsic value is greater than the stock price, that's a potential buying opportunity, as the market may be undervaluing the company. This method helps you identify stocks that have the potential to grow significantly over time. To spot undervalued stocks, you need to go beyond just looking at the stock price. You must dig into the company's financial statements, analyze its cash flow, and assess its growth potential. Buffett is known for thoroughly researching businesses, ensuring that they have a durable competitive advantage, and that their intrinsic value is not only underestimated, but also sustainable. This approach ensures that you're investing in businesses with strong fundamentals that will thrive in the long run. Patience is key when hunting for undervalued stocks. The market can sometimes take time to recognize a company's true value, but with intrinsic value as your guide, you'll be able to make more informed decisions and take advantage of opportunities before others catch on. By focusing on long-term growth and buying stocks below their intrinsic value, you position yourself to capitalize on the market's inefficiencies, just like Warren Buffett. Now that you understand how to calculate the intrinsic value of a company, you're equipped with a powerful tool to make smarter investment decisions. By focusing on the true worth of a company, its ability to generate future profits, you can avoid buying overpriced stocks and instead find those hidden gems that the market may have overlooked. This strategy is what has helped Warren Buffett become one of the wealthiest people in the world, and now you have the chance to use it too. So, what's next for you? Will you take the time to calculate intrinsic value before making your next investment? Remember, the goal is to buy companies that are undervalued and hold them for the long run. This approach might not give you instant results, but over time, it's one of the most reliable ways to build wealth. If you found this video helpful, make sure to hit that like button and subscribe to the channel so you don't miss out on more tips and strategies like this. Comment below with any questions you have, and we'll be happy to help you along your investment journey.